Today we're going to talk about good debt versus bad debt. I'm going to share with you tips on how to use leverage to safely build wealth that could possibly last for generations. You see, success is a mathematical equation. When you know the equation and you know the action steps, you too can achieve great wealth. So let's get into it. First, there's a myth out there that all debt is bad. It's true that some debt is bad. There are lots of people out there, myself included in the past, who got in over our heads with bad debts, like credit card debt and things like that. So bad debt in a summary is this, and I learned this from reading the book Rich Dad, Poor Dad by Robert Kiyosaki. When I first read it in the late 1990s, it changed my life. Robert Kiyosaki says that good debt is anything that puts money in your pocket, like a rental property. If managed well, will produce positive cash flow every month. Even if you have a mortgage payment to make, you're making more money per month than the mortgage payment. So that's putting money in your pocket. That's good debt. Bad debt is anything that takes money from your pocket, like a car payment. Unless, of course, you are using your car as a rental for somebody. But realistically, a car payment is generally bad debt because you get to use the car, but it's taking money from your pocket instead of putting money in your pocket. Kiyosaki even describes other things like boats. A boat payment takes money from your pocket. Sure, you get to enjoy being out on the water, I hope a lot, but it costs you money and it doesn't make you money. It depreciates in value, just like a car does. The moment you drive it off the lot, it goes down in value. Bad debt can also include credit cards. Oh, those are bad. You make impulse purchases and then you incur months and months of interest, and it's hard to get out from a large credit card balance. So let's dive deeper into good debt and how to use it. Make debt your friend, not your enemy. Where possible, only borrow money against assets that appreciate in value and produce cash flow. Don't borrow against assets that go down in value. For example, if you can, try not to take out a loan to get a car. Buy a car in cash. I know that's not possible for everybody, but if you live below your means, you have the opportunity to build wealth faster. You see, you should begin with the end in mind when you're investing in real estate. You need to know your strategy. There are no get-rich-quick schemes. So let's talk about how you can build income and wealth through real estate. You could buy single-family homes, multifamily homes like 2 to 4 units or maybe 10 unit or 100 unit apartments. You could buy mobile home parks, perhaps commercial properties, office or retail or special use. You could buy mixed use properties where there's perhaps a retail store on the first floor and apartments above. You have lots of opportunities. Here's a quick example of using leverage to build wealth and cash flow over time. My wife, Amira, and I purchased this townhouse 5 years ago, and we bought it for $122,000. Here's a quick backstory. It was listed on the MLS, the multiple listing service, that day. We immediately went out to see it, and when we called the listing agent that afternoon, he said there were already 2 other competing offers on it. The property was listed for $125,000. We offered $122,000, which turned out to be the lowest offer price out of the 3 offers. And we said that we would put down 15% and use a conventional loan to buy the property with a closing in 17 days. We also chose to waive inspections. Now that meant with an 85% loan to value type of loan on $122,000, we were going to borrow $103,700. Now, the market rents in the area had been $800 a month. In fact, the prior tenant who had been in this very property was paying the previous owner $800 a month. My wife and I bought the property and we rented it the night before we closed on it for $1,225, which was $425 more than the previous tenant was paying. We spent $1,500 on improving the property. Now, we borrowed 5.5%. And so we made payments, and about 15 months later, we decided to do a rate term refinance because interest rates had gone down. As I said, we were paying 5.5% in interest, and the new interest rate was 3.375%. A rate term refinance is not a cash out refinance. It's just a new loan at the same amount that we owed before, but at a lower interest rate and therefore a lower monthly payment. Now, when we first bought the property, on day one, the cash flow each month was $425. It went up. The cash flow today, 5 years later, is $1,047 a month. I'm going to explain how. You see, the property's rent has gone up from $1,225 a month when we first bought it to $1,740 a month. And the property value, according to Zillow, today is $241,000. Again, we bought it for $122,000 and it's gone up almost double. Now, in the 5 years that we've owned this cute little end-unit townhouse, we did pay $1,100 for new windows, and we spent $4,000 on our new HVAC system. However, it has been low maintenance, and the homeowners association takes care of the roof and the siding. And after a big storm, they replaced all the siding. To sum up regarding this townhouse, we've gotten back all of our original investment. Our original down payment was $22,047, and we've gotten all that back. We make over $12,000 a year in free cash flow on this, and as you can see, it almost doubled in value. So we're going to talk about the benefits of using mortgage debt to buy income-producing properties. Number one, debt pay down. Your tenants pay your debt down over time. They even, if you give it enough time, will pay off your entire loan. Number two, the property grows in value. It appreciates. Year over year, most real estate appreciates. In some years, it's much better than others. In occasional years, property values can go down. And in some markets, property values can stay suppressed for a while. But if you're buying in the right areas, places that appreciate in value, in the long run, you'll be just fine. Number three, there's what's known as forced appreciation or forced equity. That means that you buy a property at a lower value, below fair market value, and you improve it in some way. Maybe you fix it up and then charge higher rents. Maybe you move out bad tenants who aren't paying and put in good tenants who are. There's a variety of things you can do. Maybe you add coin-operated laundry machines or charge for other things like parking or amenities. You see, there are so many ways to increase the value of a rental property. Forced appreciation is where you take steps to improve the value. Also, with mortgage debt, the loan can be fixed anywhere from 5 years, 7 years, 12 years with a commercial loan to 30 years with a more traditional non-owner occupied residential loan. That when you have a fixed mortgage payment, you see that payment, the principal and interest, stays the same year over year, but you can increase rents most years. You certainly should to account for inflation as well as needed one-time capital expenditures like a new roof or a new heating system. So having a fixed mortgage payment gives you stability while you can raise rents over time. Another great benefit of rental properties is from the government. It's depreciation. It's a tax advantage that you have because you can depreciate the value of the property over time while it appreciates. For example, you can depreciate a residential rental property by dividing by 27 and a half years and a commercial property by dividing by 39 years. And there's even other things you can depreciate like equipment or appliances at a faster rate. Depreciation is great because the government allows you to take a tax deduction, but the property does appreciate over time too. So the value goes up while your tax advantages are there for decades. Another advantage is that you can take a tax deduction on the interest that you pay. So if you own a property outright, you have technically fewer deductions you can take on your tax return because you don't have any mortgage interest. Another benefit is that real estate is a long-term store of value. You want to put your money somewhere where it'll be safe. And by safe, I mean that real estate can be controlled. You choose what tenants get to go in there and you choose what tenants go out. You choose what the rents are in large part. Also, you can choose what you do to improve the property. Do you really want to invest a lot into it? Do you want to make it top of the line or basic? Also, another advantage is that you have insurance to protect you. You can get fire hazard and liability insurance. You can even get an umbrella policy if you want for extra insurance coverage. So if the property burns down or is damaged in some way from a storm or something else, you are protected. You don't get insurance on your stock portfolio, but you get insurance on your real estate portfolio. Another advantage of leverage is that you don't pay taxes on debt. And we're going to delve deeper into that. You see, you can use debt to get more money to buy more properties that produce more cash flow, and you don't pay any taxes on debt. And lastly, I want to say that a great benefit of rental real estate is generational wealth building. You can own a property perhaps for life, and then it can be passed on to your heirs who could own it for that generation and then pass it on to their heirs. You can also, with investment properties, sell one if you felt that the fundamentals had changed or you needed the money for something else, and you can use that sales proceeds and buy another investment property, and you would not necessarily have to pay capital gains taxes right away. You could do a 1031 tax deferred exchange and indefinitely defer the payment of capital gains taxes on the sale of the one property if you use that to go buy the next one. I want to mention a formula for knowing if your property is going to produce cash flow. Now, also understand that this formula is used by mortgage lenders when considering giving you a loan on a non-owner occupied rental property. It's known as the debt coverage ratio, DSCR, or the debt service coverage ratio, DSCR. That formula is net operating income divided by your debt payments. It has to be at least 1.2 or greater for a lender to feel secure in giving you money. You see, if you are at a 1.2 debt service coverage ratio or better, lenders feel confident in giving you money, and they lower their risk of over leveraging. And besides, if they lower their risk of lending you too much money, you also lower your risk of borrowing too much money. For example, that property I mentioned earlier in this video, the debt service coverage ratio on that one is currently 3.21, meaning that the amount of net operating income is 3.21 times the monthly principal and interest debt payment. So we have a tremendous amount of equity in that property. I could borrow more against that property to go buy the next one if I wanted. Several years ago, before my wife and I bought our first investment property together, we had a brief conversation about focusing on all of our money on just paying off the loan on our own home. And our interest rate is 3%. And I'm glad, and she's glad, that we chose not to apply our capital toward paying off a 3% loan. You see, if you can get a 15% return on investment or a 20% ROI or 25% ROI on an investment, instead of applying money toward a 3% loan, why don't you put the money toward something that will make even more money? Because if you pay down debt, the savings you have, or ROI, is really the interest rate. So it was foolish of us just to apply money to pay off a 3% loan when we could go make money. And also, I want to say that we found ways to create an infinite return on investment. An infinite return on investment is where you get back your original capital and you still have the investment giving you appreciation and cash flow. I'll explain a little more about that in this video. I know somebody who, and I'm not saying they're wrong, yet they missed out on an opportunity. They chose several years ago to pay off the mortgage on their own home. It was a low interest rate mortgage, and they spent several years working, two people, husband and wife, with two incomes, to pay it off. And they did. The problem is that they want to buy investment real estate now. Housing prices have almost doubled in the time that they spent to pay off the loan. and the interest rates are more than double what they were several years ago when they first started aggressively paying off their loan. So you see, they have to pay more, a lot more, in terms of purchase price and interest payments to get the same type of house today. I did a calculation looking back, and in the time I would have spent paying off the loan on my own home, my wife and I bought 6 investment properties with the same money. 6. So had we chosen to pay off our own home, we would have 0 investment properties in that time frame. Instead, we have 6. And the cash flow on those 6 is ridiculous. You're the CEO of a business, your business. And CEOs have 2 basic responsibilities. 1 is to solve problems, and 2, to maximize their resources. If you choose to be ultra conservative, you will not get the results. You see, in life, we don't get the income that we want. We get the income that we deserve. If you take certain action steps to acquire assets that produce income, and you roll that income into acquiring more assets, over time, you will build a tremendous amount of wealth and positive monthly cash flow. If you choose not to use leverage, you will not earn anywhere near as much as the investors who wisely use leverage. Now, I do want to caution not to over leverage. My wife and I do have more equity in our properties than debt, far more. So our debt is only a fraction of the total value of our properties. We could certainly borrow a lot more money, and maybe we will in the future, but for now, we are ensuring that we have very strong cash flow and keep our debt under control. Now, I mentioned about how you can have an infinite return on investment if you get back all of your original capital and still have the asset and receive cash flow and appreciation from it. I'm going to explain here how. Now, you go to my blog site at investandtransform.com for more. In fact, I'm going to reference a specific blog. The link is in the comments below. And this is an actual deal we did in 2022. We purchased a house for $138,000. We spent just over $1,400 in closing costs. We prepaid insurance for the year. We spent $30,019.93 on the renovation, and then we rented it out for $1,800 a month. So 6 months later, we had $161,391.19 left in the deal. We got a loan at 75% loan to value. The property appraised for $265,000. So what we did was we got 75% of that as our loan. You can see that the loan amount was $198,750. We did pay some extra points to get the interest rate lower, and we received a check for $188,974.51. So we got back the original principal plus $27,588.32 in surplus funds. And what did we do with that? 30 minutes later, we bought another fixer-upper house with it. You see, in 6 months, we bought this property, fixed it up, rented it out, refinanced it, pulled out our original cash and extra money, and then bought another asset with it right away. So our return on investment on this property is infinite. And the cash flow we receive on this house is $646 a month. That's awesome. And it's a cute house. I love it. The technique I just described is known as BRRRR. That stands for buy, renovate, rent, refinance, and repeat. You can buy a slight, moderate, or major fixer-upper, fix it up, rent it out, and 6 months later, it's considered seasoned in the eyes of mortgage lenders, which means that they will do a new appraisal, and it'll appraise at a higher value, and the lender can give you up to 75% loan to value, meaning that they'll loan you 75% of the appraised value. And if you handle your renovation right and you do your math up front, you could get back most, if not all, of your original seed capital. And then you can go reinvest it elsewhere. if you are good at vetting tenants, or if your property manager is good at it, and I hope they are, then you should get great tenants most of the time. And if you're responsive with their repair requests and other needs, they won't want to leave unless there's some kind of major life change. Make sure you like and subscribe our YouTube channel, and also check out my book, How to Become a Wealthy Real Estate Investor, 101 Things You Need to Know Right Now. I'm Ty Desa. I'm passionate about helping people build wealth safely through real estate.